Hey everybody, Marty Mazur, good afternoon. 15th of March 2016. Just a quick commentary for you and just a quick peek at the charts. Well, the Fed meets today and tomorrow. Tomorrow we'll get the announcement. We should not see a Fed rate increase, but the market is going to be very sensitive to what the statement says about their opinion about the economy, about inflation, and where they should go from here in terms of interest rate policy. I would say that if the Fed were truly data dependent and that was it, with the employment situation of late, with the uptick in some of the key inflation signals and inflation readings, you'd think they would be raising interest rates tomorrow. But as I've talked a lot about the last couple of years, this Fed is exceedingly sensitive to financial markets and to the value of the U.S. dollar. They do not want to do anything that's going to roil the markets nor push the dollar up substantially against the currencies of our trading partners. So they're going to be very sensitive to that, but I do think they should signal that we do have indeed a rate hike or two or three in front of us between now and the end of the year. And I think that should be the market's view as well. So the fact that in light of how the trading has been in the recent past around the commentary that suggests the Fed will raise rates or what occurred in the aftermath of the December rate hike, you would think this market would be selling down going into the meeting, particularly when oil has been going backward the last couple of days. And I think the market has been holding up marvelously. And I think that speaks to what I've been talking about last couple of weeks, and that's the very strong breadth in terms of the sector by sector look at the S&P 500. As of yesterday, 90% of the stocks in that index are trading above their 50-day moving averages. And that's very unusual in terms of the last few years. And typically, that's a pretty bullish sign when you look out, a few weeks or a few months. Now, it's interesting because I looked at some data today. The week following that kind of reading, when we hit that level, generally is, on a 50, it's up about half the time, down about half the time. And typically when we get to that strong a reading, it's because the market has traded up noticeably and in very broad-based fashion. So it's easy to get to an overbought position, and it's time for the market to do a little correcting. I think we've had 4 weeks in a row with the S&P higher. So it wouldn't surprise me to see the market trade down a bit from here. But when you go out a month and 3 months, suddenly the history suggests that this very strong breadth is a very bullish indicator. So if history does repeat itself, if that is indeed bullish, before we get too close to the election, it wouldn't surprise me to see this market possibly test the highs of last May. Again, I make no guarantee, and I don't think it matters for us long-term investors, but it'll be certainly interesting to see if indeed the recent patterns do point us in that direction. So when you look at the chart and you just look at the price action and the trend lines, I told you here that we were coming into that upward sloping wedge pattern and we should break out to the downside, and we did. And I drew a kind of a tentative support line here to catch that level of support. We'll see if that turns into a new trend line. But you can see what was support then became resistance here. And I want to just kind of draw one more for you and connect these two highs. And suddenly we have a trend line that maybe technicians are looking at, because you see the market dancing along there. And if this is the case, and if this is indeed the support line, what do we have? We have another upward sloping trend line, or I'm sorry, an upward sloping wedge pattern, which typically means you see the market break down below that. And that might make sense, and that's consistent with what I said about these breadth readings and what may occur in the very near term. But then if it's as strong as I think it might be, then you find support perhaps right here at this retracement, or a little higher than that, maybe at this 1990 line, and then you see the market trade higher. So I can tell you with a great deal of confidence what the technicians are looking at and how they may react to it. If we break out above this and this becomes support, then we may get and start testing some highs sooner than we might otherwise think. If we break below resistance levels that have been prior support levels, I should say, we could trade a lot lower in this market. So I'll say it again, folks, I'm kind of on the fence. I think the risk to the market is pretty balanced in the near term. However, I would say in the intermediate term, if that means the next few months, I'd have to have a bullish bias based on the underlying strength in this rally. And this is the kind of strength we haven't seen for quite some time. So I'll say it again, for you and me, long-term investors, this is not actionable stuff. But I do find it helpful to our clients to help give them some perspective on what pushes the market around in the short term. And perspective helps us keep our wits about us. So folks, I'll just leave it there. I'll probably be back tomorrow to talk about the market's reaction to the Fed's announcement. And it'll be interesting, to say the least. Talk to you soon. Bye-bye.